Hey, well, inflation vaccines are here. What in the world is an inflation vaccine? The housing market has shifted. Let's talk about why and how. Is a housing crash imminent? We'll answer that. Depending on who you are and what situation you're in, we're going to talk about how you position yourself in the shifting housing market. Also, a way for you to lower your mortgage interest rate. Stick around and settle in, because by the end of this, you're going to have answers to all of those questions. Hi, I'm Keith Weinhold. This is Get Rich Education. The main reason that the housing market has shifted is decreased affordability. Now, demand has waned somewhat, though not very much, and supply is still really low. In fact, a lot of this is demonstrated right here in this chart for the number of days on market. This demonstrates that housing demand still vastly exceeds supply. In fact, in the entire history of this, going back to 2011, the fewest days on market ever was 29 days. So anything around 30 days means that properties are flying off the market pretty briskly. And by the way, what this means, days on market, if you're still not sure, that is every day that a listed home sits on the market unsold. A lot of times you'll see this abbreviated out there, DOM, in the multiple listing service and elsewhere. So this really shows us that there aren't any signs of a crash at all. Now, depending on how you're positioned in the market, that is going to make the difference with how you respond. So let's take a look at this shifting housing market based on this new landscape of high inflation, higher housing prices, spiking rents, and higher mortgage interest rates, and how that affects three groups. So we're going to talk about how this shift affects wannabe first-time homebuyers, existing homeowners, and opportunists looking to invest dollars today. And you might find yourself in more than one of those groups. And if there's one group that feels like this shift is a bunch of bullshift, sorry, I had to do that. It is wannabe first-time home buyers, because soaring home prices and higher interest rates have conspired for a 1-2 affordability hit. Now, a good rule of thumb for you to keep in mind over time is that every 1% increase in mortgage interest rates decreases affordability by about 12%. So let's go ahead and take a look at a real world example here. How this looks when coupled with appreciating home prices. So with 20% down and an 80% loan, 1 year ago, let's say there would have been a $360,000 home, often would have had a 3% mortgage rate and a monthly payment of $1,214. Well, today, that very same home could cost substantially more, $420,000, and at a 5.75% interest rate, something you'd be more likely to have today, that payment would be $1,961. Just take a look at that. That's about a 50% difference right there. But yet, you know what? Today's higher payment, that's probably going to look attractive by year end, when higher prices and higher mortgage rates are both expected up till the end of the year. I think it's even more likely that you're going to see higher home prices than you will higher mortgage interest rates, but both are expected. Due to the increases, I was just on television advising that a home buyer target a property 10% less than what you can afford. This is some advice I actually have for first-time home buyers right now.
A tip from real estate investor Keith Weinhold is to target a home that costs 10% less than what you can afford.
If mortgage interest rates rise during the purchase process, you don't have to cancel the contract. You can still afford the home. So the bottom line is just set your budget for something 10% less than what you can afford, and you won't have any surprises. And I'm not a live small and make a budget kind of guy. I am in the opposite position, but this strategy of targeting something 10% less than what you can afford, that protects you against this life upheaval if you have to make a purchase cancellation due to more spiking home prices or spiking rents at faster rates than usual. But see, people that get priced out of home ownership, they want to be over here in the homeowner, the home buyer area, but now they get priced out due to higher mortgage rates or higher prices. Oftentimes they have to return to the renter pool or just stay in the renter pool. So we've got this growing renter pool. In fact, this decreased affordability for home buyers is actually what is driving soaring rents, with this swelling renter pool increasing demand for rents. People have to live somewhere. So let's take a look at this homeownership rate chart. You can see it's about 65% right now. Well, this current 65% national homeownership rate, the flip side of that basically being a 35% renter rate, that is poised, the homeownership that rate is, to fall, which will increase the rental rate. That's what I expect to see. So that's the first group, want to be first-time homebuyers. The second group is existing homeowners that have accumulated equity. Let's look at them. Hey, go ahead and put a like on this. It doesn't necessarily mean that you like the shifts in the housing market, although you might with these increasing rents. I'd really appreciate the like. Besides the fact that the rate of return from home equity is always zero, high inflation, understand, it's now debasing your equity faster too. If you didn't catch that, yes, the rate of return from home equity is always zero. If you're uninitiated on that, maybe you're thinking like, well, what are you talking about? House prices have increased 15 to 20% year over year. No, that's the overall capital price of the asset. I'm talking about how your return from home equity is always zero. If you don't understand that, check out this video up here on why your return from home equity is always zero. It's really paradigm shifting. But inflation debases your debt at the same rate that it debases your equity. So from this perspective, it's wiser to have less equity and more debt. But see, now there's somewhat of a problem. A year ago, you might have found it super attractive to do a cash out refinance of accumulated equity in a property because you could go ahead and refinance the entire loan at maybe a 3% or a 4% interest rate. And today, you'd have to refinance at a 5% to 6% interest rate in order to get access to that zero return equity so that you can go invest it for a return somewhere and have it separated from the property, if that's something that you wish to do. But the problem is, yeah, today you would lose that subterranean mortgage interest rate. But you know what? There is a way that you can have it all. If you have accumulated equity in your property, you can keep that first loan in place. Don't touch it. Just let it go there. Let it continue to amortize, and you can stay locked in at that low rate. And you can add a home equity line of credit second mortgage without touching that first one. And you're still going to need to keep about a 20% equity cushion in place after you originate a HELOC second mortgage. And personally, that is a strategy that I've employed. You got to look at that closely though, and your HELOC rate might be subject to rising interest rates and a higher payment down the road. Something you definitely got to consider. That's a strategy that I have employed myself with that HELOC second loan. Now, alternatively, if you want to refinance your property into something with a better interest rate than a fixed rate mortgage, and say you want to go refinance the whole thing, you can do that with, say, a 5-year adjustable rate mortgage, or a 7-year, or a 10-year adjustable rate mortgage. And you know what? A lot of people just summarily dismiss ARMs and adjustable rate mortgages, thinking that they're no good. But note that today's 5-year ARM rate is a full 1 to 1.5% lower than the 30-year fixed rate mortgage. Yeah, you actually pay a premium for having fixed rate certainty over a long period of time, and almost everyone that gets a 30-year fixed rate mortgage, almost no one, only about 1% of people actually go and make all 360 payments over time. Very few people use all that term. Understand, with a 5-year ARM, understand that what a 5-year ARM means is that for the first 5 years that you have that loan, your mortgage interest rate stays fixed. It doesn't begin to adjust until after 5 years. With a 7-year ARM, with a 10-year ARM, yes, those 7 and 10 years are the fixed rate periods, and then your rate only adjusts thereafter. So you still do get several years of certainty, typically at a lower interest rate. So an ARM, it could be a good choice for you if you're pretty certain that you're not going to be holding on to a property for a long, long time. However, an ARM could be a really poor choice for really short-term holds. That's an option for you to lower your interest rate. Now, the third group that we're talking about here with the housing market shift is opportunists looking to invest new dollars. What's someone to do that wants to get a yield today and is trying to beat inflation? You're looking to protect what you have while getting growth at the same time. By buying good income property with a loan, you expect to benefit from ever higher home prices, although you can't absolutely count on that. Soaring rents. In fact, they're soaring at 26% nationally. Taking a quick look at this rentreport.com rental report. And you would also benefit from inflation profiting on the debt if you do this. Could we then say that buying entry-level rental property with a loan is much like getting an inflation vaccine? Yes, I think we can. The inflation vaccine has nothing to do with the CDC or Dr. Anthony Fauci. It's about strategically and wisely borrowing dollars. You know, over the last 2 years, gold and cryptocurrency speculators, they probably had the right idea by going into those things, thinking about them as inflation hedges. They thought they were vaccinating themselves against inflation, but gold and cryptocurrency have gone either down or nowhere for 2 years. Fixed rate debt on an income property means that you beat inflation directly. You don't have to speculate. Your principal and interest payment stays fixed long term at a time when rents are surging fast, and your debt also gets debased by high inflation. So if you think that the dollar is going to keep getting debased, rather than save and have those savings get debased, you do the opposite and borrow. So let's take a look at this, because when you borrow for an income property, your mortgage payment and operating expenses are outsourced to a tenant. So today, that rent income might be, say, $1,500 in an $800 mortgage. In a year, your rent's up to $1,600 in an $800 mortgage. And notice, I'm not appreciating these rents anywhere nearly as high as rents are increasing today, because that's not sustainable. I'm just being conservative. And in 10 years, you'd have a $2,500 rent income and an $800 mortgage. It could be even more favorable than that, but just goes to show you that your principal and interest stays fixed depending on your loan type. Most people are getting that long-term fixed interest rate debt, so you're widening and widening and widening your delta over time. You're serving that swelling category of renters that continue to be priced out of an increasingly exclusive homeowner market. That's a big part of the shift and how you can position yourself to benefit from it. So yeah, consider yourself immunized against inflation. Hey, well, as you watch this video, what are some of the things that you thought about that perhaps I didn't address? Or did I say something that made you think of something else and you have a question about that? Go ahead and leave a comment below and I will try to reply myself, and you'll know that it's me because I'll put a -Keith in my reply. Thanks so much for stopping by. I'll see you in the next video. I look forward to replying to your comment.